One thing that did change over the quarter was that volatility returned to markets. And PIMCO has been cautioning that volatility would return back to the markets, certainly since mid-2017. I suppose careful what you wish for here, as we see a pretty significant spike out in volatility over the past quarter. But it was fairly contained just in the equity market. It didn't spill over much into the rate or the FX or even the credit space. So Scott, what should investors, or how should investors position in the context of rising volatility?
Well, we've been pounding the table for a while. We still think it's right to do that because, as you mentioned, yeah, we've seen volatility spike, and so the averages are sort of starting to reassert themselves, particularly in the equity market, but it has not yet moved fully into other asset classes back to a normal level. So we think investors should prepare their portfolios for that. It's a very different set of strategies and a very different way of thinking than much of the last decade. So we're coming out of, I would say, the decade when selling volatility in all sorts of either explicit or implicit ways was rewarded. And we're entering a less friendly regime for that. So to us, that means more defensive portfolio posturing. Look at the ways that an increase in volatility or a return to a normal risk premium could impact your strategies. So that's really the big implication. When you look at all sorts of risk premium, they've been compressed. Mainly due, in our opinion, to low volatility. So as that begins to expand, it starts to pressure multiples. It means wider credit spreads, steeper credit curves. It means the compression between liquid and less liquid assets begins to go away, and you get that decompression. So it means focus on higher quality, focus on more defensive strategies, and be very careful about selling liquidity too cheaply.
Okay, so fairly cautious view in terms of portfolio construction today. Maybe we'll take a look at the next chart and just take a look at the movements that we've seen over the past several quarters, and then specifically in the first quarter of this year in terms of the yield on the 10-year Treasury. Almost 160 basis point movement since the lows of mid-2016. So Scott, I'm going to ask this one to you again. Are we entering or are we in a bear market for bonds?
So we don't think so. I mean, it's the reasons that we cited in terms of believing that, after this pretty rapid repricing in the bond market, we're approaching the levels where the market it's got priced in our view of a return to neutral monetary policy. It's got the return of a little bit of risk premium for inflation going back to the Fed's target. Now, maybe there's a little bit further to go. We would argue that there probably is in the case of the bond market, especially for longer dated, longer maturity bonds, where we haven't seen a full normalization of term premium and risk premium. But certainly after this repricing, there's a lot more value in the U.S. high quality curve, particularly in that 5 to 10 year space. And particularly when we look at the U.S. versus the rest of the world, where spreads are much lower relative to fundamentals.
Maybe we can turn now and take a look at the yield curve and continue to talk about kind of rate strategies here. So as we see in the chart, the current curve continues to flatten. We're showing here that during periods in which you see a recession, we've actually seen preceding that periods where the curve is actually inverted. So I guess the question here for Joachim is, will it invert, and does this mean a recession is looming?
Well, first of all, it's important to point out that an inverted yield curve does not necessarily cause a recession. There's a misunderstanding often. So it's been a good signal in the past, at least over the past 30, 40 years. Whenever the yield curve inverted, you got a recession. But I think it's very important to look at why the yield curve inverts. So if the yield curve inverts because the Fed commits monetary overkill and pushes short-term interest rates too high, then the yield curve inversion will lead to a recession. But it's the Fed that's causing it. It's not the yield curve itself. Conversely, if you have a situation where, for example, there is strong foreign demand for bonds, for US bonds, which is keeping the long end anchored, keeps long-term interest rates low, then that's not necessarily something that would cause a recession. So I think there can be periods where the yield curve inverts without this leading to a recession. For example, in the mid-1960s, there was a period when the yield curve inverted, but you did not get a recession after that. Now, having said that, we actually do not expect the yield curve to invert. We actually think the yield curve is more likely to steepen, to re-steepen. One reason for this is that we think there's not enough inflation risk premium priced into particularly in the long end of the curve. And the second reason is that we get a lot of supply of bonds because of the fiscal expansion. So this is why we think the yield curve won't invert. But again, even if it did, this would not necessarily mean that this causes a recession.